Good morning, ladies and gentlemen. A very warm welcome to you on Friday. The shade is dark green on the Lal Street, and it's a very, very welcome change from the past 5, 7, 10 trading sessions that have gone past us in this very turbulent and painful month of December as far as markets are concerned. The Nifty now reclaiming 25,900 by the bulls. Strength in the IT space and strength in banking also helping the Nifty on the way up. Frankly, 2025 has been a year which you would want to forget. Nothing has happened in the capital markets despite whatever the government that could do has been done. Mid caps and small caps are in pain, and most investors would like to forget 2025 as a bad dream. What holds us together is hope and expectations that 2026 will be better. Now, what will happen in 2026? What is the outlook for the next calendar 12 months? We are joined by Mr. Sadip Bansal, Deputy CIO at ASK Investment Managers, one of the companies which were pioneers in the PMS space and continue to do phenomenal work creating long-term wealth for their shareholders. Namaste Sandeep ji, as always a very warm welcome. As we were discussing offline, 2025 is something that many of us would like to forget as a bad dream, a nightmare. What are the 2 or 3 things that you're looking forward to in 2026 in terms of outlook for equity markets?
Namaskar Shailendra ji. In 2026, firstly, what we are looking forward to is pickup in earnings growth. Our sense is that the first half of the fiscal year FY26 was not good for earnings. We saw earnings growth of just about, let's say, 4 to 5% in the first half. In the next half of the year, we are likely to see earnings growth of about 10%. And this is going to build into FY27 when the earnings growth trajectory is likely to be around 14 to 15%. So pickup in earnings growth is the first thing. The second thing is improved sentiments. That could be on the back of a trade deal with the US, maybe a better external environment than what we've experienced in the last 1 year. We've made progress on signing bilateral agreements with many other countries as well. That would start to reflect in our numbers. So that would be the second thing that one is looking forward to. Third thing is we've seen weakness in the markets across the breadth of the markets. And now, as growth starts to pick up, as government activity on the ground starts to pick up, we do see that starting to benefit a lot of companies. So that activity could be in terms of government awarding more projects, ordering, tendering picking up, execution picking up, and the private sector CAPEX cycle picking up, especially given the fact that we've seen a good 125 basis points of rate cut this year since February onwards, the benefits of which unfortunately could not be reaped in this year as much because the CAPEX cycle did not kind of start. Maybe that will happen next year. And we've also seen a lot of capital market activity in terms of capital being raised. All of that hopefully will start to get deployed next year onwards.
Okay. On that very optimistic and hopeful note, Sandeep ji, let us now take this discussion forward. You are blessed with an environment where your clients are sending you money on a monthly basis as fresh investments into the market. How do you see yourself deploying fresh funds at this stage? What are the 1 or 2 sectors that are attracting your attention?
So we are primarily investing money in domestic oriented businesses which are leveraged to a cyclical recovery. There unfortunately is not any one particular sector, but if I had to take a basket of sectors, it would essentially be BFSI is the primary one, along with consumption, discretionary consumption, and a basket of manufacturing and capital goods sectors. But within that, BFSI as a space, we like because of a pickup in credit growth, which in our view is going to gain momentum going forward, good asset quality, and attractive valuations. Also, we've turned tactically bullish on the IT sector, given where the currency is, given the current account deficit situation, given the rise in gold prices and the effect on the currency, given the attractive valuations in the sector, and the outlook on the sector is also improving from a demand perspective.
I think you've summarized the entire structure of the market really well, and this is a hopeful turn of events that we all are looking forward to 2026. Sandeep ji, at this point of time, how are you characterizing the rupee? You did mention a technical bet has emerged on the long side because of export orientation of our IT sector. So that's very well put. But for fund managers such as you, is this constant weakening of the rupee a pain point, a nightmare perhaps?
So, from an economic standpoint, Shailendra, our exports actually benefit from a weakness in the rupee. To some extent, it also helps us to mute the impact of tariffs that have been put by the US on us. So that is the other aspect. Do imports get costlier? The answer is yes. It especially hurts us on the engineering capital goods side, whatever imports we are having, and also on the oil side. But fortunately for us, oil prices have been muted. Is currency volatility something which we look forward to? The answer is no. But is it something which is part and parcel of the markets and we have to take it in our stride? The answer is yes. We need to, in markets, tune our bets according to the emerging macroeconomic and market situation. And hence, what we've done is that we have taken a tactical bet, let's say, on the IT sector to adjust to the situation of a weakening rupee combined with attractive valuations and perhaps an improving demand scenario. So these are the adjustments which are part and parcel of the fund management business, which we continue to do.
Okay. Sandeep ji, one thing that has emerged as a consensus over the last 5-7 months or so is that money managers such as you are now concentrating on large caps. Now, whether it's relatively better valuations versus mids and smalls, or the simple understanding of the practicalities of life that big gets bigger. The sectors that you mentioned that you are going long, which is BFSI, consumption, which is domestic oriented, as also IT. What is your preference pick? The large cap in this sector, or are you looking at mid caps? How are you deploying within a sector?
Sure, Shailendra. So we have been bullish on large caps relatively for a while now. We have had a lesser preference for mid and small. The reason was we felt mid and small as a basket valuations are still high in an environment where there was a growth reset that was underway. Are there pockets of opportunities within the mid and small cap space? The answer to that is yes. But still, if I had to take a broader view, I would say that large caps as a basket still continues to offer far better risk-adjusted return opportunities. The point of favoring large caps wasn't as much that the big is going to get bigger. It was more to do with the fact that these businesses have had the experience of growing across cycles, managing economic as well as business cycles. their valuations were also far more reasonable. There was far more money chasing the mid and small cap basket, and maybe the large caps were also suffering from, let's say, FII selling, etc. So these were the reasons why we preferred large caps. If I see our flexi cap portfolios, we still have a very heavy tint towards large caps, and we continue by that stance. So yes, across our favored sectors, whether it be BFSI, consumer discretionary, manufacturing, infrastructure, we continue to be more large cap biased.
Okay, fair point. So large cap, BFSI, IT, and of course opportunities that are available on the deleveraging side. Uh, Sandeep ji, 2025 has left us with a lot of pain, especially for the new set of investors who came in 3-4 years ago, uh, really enjoyed the last leg of the rally, and now unfortunately saddled with largely a mid cap, small cap portfolio that's down 25 to 40% depending upon what you have. Now, what is the advice that you hold out to them after being in the markets for 3 decades? What should they be doing? Cleaning it up, starting afresh, average lower, or hang on?
So, Shailendra, the businesses in the mid and small cap space, wherein there are competitive advantages, wherein the balance sheet is good, where the management is strong with a clear vision and an execution track record, if they have gotten, if their share prices have undergone pain due to collateral damage because of selling in the entire mid and small cap space, I think those stock prices perhaps are going to come back. In fact, we are also searching for such opportunities in the markets. But businesses or stocks which were more dependent, which had run up just because of a narrative, which had gone up because there was too much liquidity chasing them, or businesses with weaker balance sheets, not so great corporate governance track records, those businesses might, in our view, could find it difficult to come back to these earlier prices. Now, cleaning up one's portfolio of such businesses is always a difficult choice to be made, a difficult decision, because losses need to be booked. But I think the sooner that one does that, the better it is. Obviously, there is going to be market volatility, and perhaps one could get a chance. At those times, maybe it would better. It would be better to just book whatever losses one has to, rather than getting too greedy. Obviously, it would be very company specific, and this is what I've said is more of a generic statement.
Yes, I think for all sorts of players, the market does take a learning fee, and the learning fee is often paid in booking losses. That's how it is, how it was, and how it will be. Sandeep ji, in terms of what 2026 could bring for our foreign friends as far as their Indian exposure is concerned, what is your view? Do you see them returning, or will they be picking away, rich pickings thanks to a lot of money that is coming in from the domestic retail side? We are providing them with great exit. We are providing many we are providing many venture capitalists and many promoters with a great opportunity to sell to retail and exit at very high valuations.
Sure. So I think there are two parts to the question that you asked, Shailendra. One was, regarding FIIs maybe, and the other was regarding the domestic investors. As far as FIIs are concerned, I think there has been a greater inclination to invest in markets where there are AI plays available, maybe markets like China, Korea, etc. India is not looked as one of those kind of markets. Also, India's valuations versus other emerging markets and versus its own historical valuation levels were higher in the last 1.5 years. And that was in an environment where growth was getting reset downwards. So that was perhaps the reasons for FII selling. And then in recent times, it has to do with the currency as well. My sense is that as the differential of India with the US in terms of inflation, in terms of interest rates is coming down, as our macroeconomics fundamentals on a relative basis compares very well, our sense is that given the long-term growth trajectory of India, FIIs are likely to return to the markets. As far as the Indian retail investor is concerned and their appetite for investing in markets, yes, the returns over the last few years, especially post-COVID, have been good, and that experience is helping investors to continue with their investing in India. Obviously, wherein valuations are high, where there are a lot of mid and small cap stocks, where there are narratives, yes, retail investors do need to be careful. There is no doubt about that. But are there enough and more opportunities available in the Indian markets to make money? The answer is yes. And the long-term growth story of India still remains intact. And markets at an overall level, if we look at it, are trading at about 21 times 1 year forward earnings, which Shailendra is about the average levels of the last 10 years.
Okay.
So long-term investors can continue to look at Indian markets favorably.
Fair point. Sandeep ji, I again come back to the rupee. What do you think is the real exchange rate for the rupee where you would be comfortable with? We have already breached 91.
Yeah. I'm not a currency expert, but my view would be that the fundamentals of the Indian economy on a relative basis are strong. Our interest rate differential with the US is actually coming down. Is there an impact on the CAD due to the tariffs by the US, and are our exports lower? The answer to that is yes. A lot of that might have already played out and reflected in the numbers. Currency markets, like stock markets, it becomes very difficult to say at any point of time how much lower or higher it could go in the near term. But from a fundamental standpoint, the economy is on a solid footing. As and when we have a few trade deals in place, FII flows, etc., stabilize, a lot of the FDI related announcements that we've seen when money starts to flow in, we could see things stabilizing.
Right. Sandeep ji, I think we've pretty much touched a very wide gamut of subjects covering large mids where money is flowing in, what could be the value of the rupee. I take this opportunity to wish everyone at ASK a wonderful year ahead. May the pains of 2025 go away, and the stellar returns that all of us have seen in 22, 23, 24, may they come back upon us in 2026. Thank you for your time, and here's wishing you a Merry Christmas, a Happy New Year.
Thank you so much, Shailendra, for having us on the show, and wish you and everyone in your team a very Merry Christmas and a very Happy New Year.
With that, Sandeep ji, let's call it a day, and I hope to meet you in person in 2026. Thank you so much for your time, sir.
Look forward. Thank you.
That, ladies and gentlemen, was Mr. Sadip Bansal, Deputy CIO at ASK Investment Managers. For 2026, the outlook is a little more better than 2025. He hopes for earnings growth to return first to 10% in H1 FY 26-27, and of course in H2 the same earnings growth would be 14% year on year. Then the weakness in the rupee has provided a tactical opportunity for ASK investment managers to look into the IT sector, where valuations have already come down, and of course the future looks bright given the record low on the rupee, because IT is an export oriented sector. Broader themes are focused on large caps, and of course there is value to be had in select mid caps too. Thank you for watching. Please be with us on Business Today Television. There is a lot of other interesting data coming on the other side of this break.
The diplomatic storm between India and Bangladesh is now dangerously reaching breaking point. Anti-India rhetoric from Bangladeshi politicians has sparked serious security concerns, promoting India to summon the Bangladesh High Commissioner in Delhi. The controversy erupted after